Across parts of the country, homeowners are opening letters from their insurance company that don't say their premium went up. They say their policy is being canceled entirely and the company won't offer a new one at any price. This isn't a small, isolated problem. Major insurers have pulled back from writing new homeowner policies in several high-risk states, particularly ones exposed to wildfires, hurricanes, and severe storms. When an insurer decides an area is too risky to profitably cover, it can simply stop offering new policies there or decline to renew existing ones. For homeowners who can still get covered, the more common problem is cost. Premiums in higher risk regions have climbed sharply in recent years, in some cases increasing by well over double what homeowners were paying just a few years earlier, driven by insurers recalculating risk after a stretch of costly natural disasters. Some states have stepped in with Insurer of Last Resort programs, state-backed plans that offer basic coverage when private insurers won't. But these plans are often more expensive and provide less coverage than a standard policy, and they were never designed to be the primary option for large numbers of homeowners. Here's why this matters even if you're not shopping for insurance right now. Nearly every mortgage lender requires proof of homeowners insurance to keep the loan in good standing. If your insurer drops you and you can't find a replacement policy in time, it can put you in violation of your mortgage terms, and some lenders will force place a policy on your behalf, usually at a much higher cost with less coverage. If you own a home in a higher risk area, there are a few things worth checking now, before a renewal notice becomes a crisis. Ask your insurer directly whether they plan to continue writing policies in your area. Compare quotes from multiple companies annually instead of auto-renewing. Pricing in this market can shift quickly. And ask about mitigation discounts. Many insurers offer reduced premiums for upgrades like a new roof, fire-resistant materials, or storm shutters. Some states also now require insurers to factor in these mitigation improvements when calculating risk, which means upgrades that used to be purely cosmetic or protective can now directly lower your premium. If you're house hunting, this is also becoming a factor to check before you fall in love with a property. A home in a high-risk zone might be difficult or expensive to insure, and that cost belongs in your budget calculation right alongside the mortgage payment itself. 3 things to do. If you're in a high-risk state, call your insurer and ask directly about their plans for your area. Don't wait for a surprise letter. Shop your policy every year instead of assuming your rate is competitive. And if you're buying a home, get an insurance quote before you close, not after. A mortgage payment is only part of the real cost of owning a home. Increasingly, insurance is the part catching people off guard. We track the financial traps that don't make headlines so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.